In the crypto market, one of the most powerful forces is not technology, regulation, or even price itself. It is psychology. More specifically, it is the quiet emotional pressure known as fear of missing out, often shortened to FOMO. This psychological pattern has shaped financial markets for centuries, but in crypto markets it becomes amplified because information moves instantly, prices change rapidly, and social signals spread through millions of screens at the same time. Imagine a typical moment that many traders experience. You open a chart and notice that a cryptocurrency has already moved upward by 10 or 15% within a few hours. Social media timelines are suddenly filled with screenshots of profits, price predictions, and confident voices saying that the real move has only just begun. At first you observe calmly, but as the price continues to rise, a subtle tension begins to form. The mind starts calculating what could happen if the asset climbs another 20% or 50% or even doubles in the coming days. At that point, the trade is no longer being evaluated purely through analysis. It is being filtered through emotion. This is where FOMO begins to operate. Human decision-making evolved in environments where missing opportunities could mean losing access to food, safety, or social belonging. Because of this evolutionary history, the brain treats missed opportunities as a form of threat. In financial markets, that instinct becomes dangerous because markets are constantly presenting apparent opportunities, many of which exist only briefly or are already fading by the time they become visible. Crypto markets intensify this pattern because of their structure. Traditional markets often operate during specific hours and move in relatively controlled increments. Crypto markets operate 24 hours a day across the entire globe, and price changes can accelerate quickly when liquidity concentrates around a trending asset. When a price begins to rise rapidly, visibility increases. Trading volume increases and attention increases. Attention itself becomes a form of fuel, attracting even more participants who feel they might be arriving just in time. However, the mathematics of market movement tells a different story. Early buyers participate in the largest portion of the move. As the price rises, each new buyer is effectively purchasing at a higher level than the previous group. By the time FOMO spreads widely through the market, the majority of the price expansion has often already occurred. The remaining upside may exist, but the risk increases because the market is now crowded with traders who entered based on emotion rather than long-term conviction. Behavioral economics describes this dynamic as herd behavior combined with recency bias. Herd behavior occurs when individuals assume that the crowd must possess useful information, while recency bias causes recent price increases to feel like reliable indicators of future movement. Together, these biases create a feedback loop where rising prices attract new buyers, which pushes prices even higher for a period of time. Eventually, however, the process slows because the pool of new buyers becomes smaller. Historical financial markets show similar patterns long before cryptocurrency existed. During the railway boom in the 19th century, during the dot-com expansion of the late 1990s, and during various commodity booms across different decades, investors repeatedly entered markets late in the cycle because rapidly rising prices created the impression that a major opportunity was unfolding. In many cases, those investors were not reacting to underlying economic fundamentals, but to the visible behavior of other investors. Crypto markets replicate these historical dynamics but compress them into much shorter time frames. What once unfolded across several years in traditional markets can occur within weeks or even days in digital asset markets. The speed of communication, the global access to trading platforms, and the transport of price charts make it easier for momentum to spread rapidly. Understanding the psychology of FOMO does not mean eliminating emotion entirely, because financial decisions always involve uncertainty. Instead, it involves recognizing the signals that indicate emotional pressure may be influencing judgment.